Hello everyone, how's it going? Hope you're all right. So today we are introducing a concept that is called contribution, and this concept is something that we borrow from our friends in accounting, and it helps us to identify exactly how much money does a company really have to pay for its costs, which we know come in two forms: fixed costs and variable costs. So first let's look at the definition, then we'll further dive into the concept. By definition, contribution is that amount of money which you've earned as revenue that you have left over once you've paid off only the variable cost of production of any product. So I'm going to highlight that here, and I'm going to emphasize it again that it is only the variable or the direct costs which are deducted from your revenue to calculate your contribution. So if I put this into a formula, it will look something like this. My revenue, which is of course coming from my sales, minus variable costs, should give me contribution. And the thing to remember, and please don't forget this, that contribution is always contributed per unit. So you calculate it for 1 unit of output, and then number of output you have, you simply multiply it to calculate total contribution should you need to do that. So if we take this concept and apply it to a business situation, let's say we are a furniture maker and we have made this nice looking cupboard and we are able to sell it for a price of $230. So of course, in making this, we know that certain costs would have incurred, rent, for example. But apart from that, there are a few variable costs that would have also incurred. And of course, that come in the form of perhaps the raw material that you would have used and the amount of labor it would have taken to produce this cupboard here. And let's say that the total variable cost for making this particular cupboard, this unit of cupboard, is $150. Now, if we have our formula, we have the amount of revenue that we're making from this product. We have the variable cost in the form of 150. If I simply minus this, I should get the contribution per unit for this product, which will come to $80. So $80 is the contribution that you would have earned from selling this unit of cupboard for this price, which costed you in terms of your variable cost only $150. Now, I'm emphasizing the variable cost again because we know there's also fixed costs, right? And that we will soon discuss that at this point, when you've calculated contribution, you've only taken care of your variable costs. And of course, in order to calculate our profit, we will also need to eventually deduct the fixed cost as well. But this method of accounting helps us to at least pinpoint exactly what it's costing to make one unit so that we can set the right price for it. Now, we also know that no business would only be producing one product with the resources that they have. Everybody wants to increase their size, of course, because of economies of scale and want to be making more profit, right? So let's take an example here of the furniture maker making maybe 3 different lines of products. So a chester or shelf here, a table and couch, and let's say they make multiple units of these, right? And we've got some numbers here that we'll need in order to calculate our contribution. So we're able to sell the whatever number of these tables or shelves that we have. We are able to sell it for $10,000. So that's the revenue that's coming from product A. From product B, $15,000, and product C, $50,000. So we can total this up and we can see that this totals to $75,000 is what you're earning in terms of your revenue. Now, in order to make this, of course, you would have needed wood, nails, handles, labor. So your variable costs are $4,000, $4,300, and $18,500 respectively for each of the products. Now, we know our formula for contribution, and that is revenue minus your variable cost should result in your contribution. And if I simply do the math here, 10,000 minus 4,000 tells me that I'm able to earn a total contribution of $6,000 from selling all of these, 10,700 of total contribution from all of these, and 31,500 from all of these. Now, at this point, what the companies would do is they would add all of these up to see what the total contribution was they earned from the sales of these products. And when we add this up, it comes up to $48,200. Okay. Now, Notice how we've only to this point taken care of our variable costs, right? In order to really calculate your profit, we also need to deduct our fixed costs. And let's say that the total fixed cost for this company for making all of these products was 42,500. Now, once we've taken care of variable costs, if we deduct the fixed cost from the amount of contribution, then this will convert into the profit that all businesses are looking to calculate. So the formula becomes profit is equal to the total contribution minus total fixed cost of making all the products. And if we solve for this here, my total contribution was 48,200. When I deduct 42,500 from it, I should then get my total contribution. The total profit, which is $5,700. So finally, it is at this point that the company can then say that, look, we've taken care of all the costs, we've paid them off, and what the revenue was, which we started with at 75,000, eventually the company will end up making 5,700 in terms of profit. That's how you use the calculation of contribution across the organization to make sure you include the unit costs of all the products, and so you're able to fully calculate the profit. Unfortunately, contribution costing also has certain limitations, and one very big limitation that's staring us right now in our faces is that when you do have to calculate using contribution costing, you have to make a clear distinction between your variable costs and your fixed costs, right? Because for the calculation of contribution, you're only taking into account the variable costs. But certain businesses will face certain costs which are neither fixed, neither variable, and we call them semi-variable costs. And it's very difficult to make a distinction between those two, and how are you going to place those? For example, when you, for example, get a new SIM for your phone and a new connection, you have to pay a certain line rent, which is fixed regardless of the usage that you have. And on top of that, then the number of calls that you make, the charge will be added to it. Or when you get into a taxi, that's where there's a charge that's already put on the bill, and then the number of kilometers that you go, it will further add on. So how do you make the distinction? What is semi, what is fixed? That's where it is difficult to use the concept of contribution costing. Not only that, it is not favored by a lot of governments, so there might be certain limitations in terms of using contribution costing, and that's where the other method called full or absorption costing might be used. And when you are looking to produce more, some fixed costs rise, right? For example, if you produce more, you will need more storage space, so you will need to have to pay more rent. And when that goes up, that means even after calculating contribution, there's a larger amount of fixed cost to be paid, which will further reduce the profit that you end up making. But it is a very useful tool. Companies still use it to make sure that all the costs are taken care of and you know exactly how much profit you have made.